Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Mosaic Company stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. The Mosaic Company mines phosphate and potash. The company is headquartered in Tampa, Florida, and was founded in 1909. It went public in 1988 and currently trades on the NASDAQ. Mosaic is the largest producer of potash. It produces 11% in the entire world. Its capacity is 10 million tons. It's also the largest producer of phosphate, producing 13% of the entire world's phosphate. It has a capacity of 17 million tons. It was founded in 2004 by a merger between IMC Global, a fertilizer company formed in 1909, and Cargill's crop nutrition division. Its customers include wholesalers, retailers, and individual growers worldwide. 95% of potash is used in fertilizers to support plant growth, increase crop yield, and enhance water preservation. Phosphate rock is processed to produce phosphorus, which is one of the main nutrients used in fertilizer. Let's get started with the model. This is a large cap company, 11.7 billion market cap. They're trading at $31 a share, and they have 379 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have positive free cash flow every year except in 2019. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that's negative in 2017 and 2019, positive in 2018 and 20. Revenue is the sales for the company. That peaked in 2018 at 9.6 billion. Then it decreased a little the following 2 years. The market price for phosphate and potash has a major influence on the company's revenue. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example is the cost of labor. The difference between those two numbers is their gross profit. That peaked in 2018 at 1.5 billion. It's at about 1 billion right now. Below that is operating expenses. Examples are marketing and depreciation. Then below that is operating income, which was the highest in 2018. It's currently around $400 million today. Then below that is the interest they receive on their investments, which is 33 million. Below that is the interest they pay in their debt, and that was 214 million. That's been pretty consistent the past 3 years. Then below that is other income and expenses. This is usually impairments or write-offs. That's why they had negative net income in 2019, because of this large asset impairment of 1.4 billion. You can see they had positive operating income that year of 367 million, but negative 1 billion of net income. That's why it's better to look at operating income. That's a better indicator of how the company's doing. Below other income and expenses is pre-tax income, then their taxes. Below that is earnings from equity interest. This is their earnings or losses from their investments in other companies. Then the bottom line of the income statement is their net income, which is positive 660 million in 2020. That's their highest net income in the past 4 years. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So you can see they generate a positive operating cash flow every year, and it peaked in 2020 at 1.6 billion. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And the reason they had negative free cash flow in 2019 was because they had a lot of CapEx that year, nearly 1.3 billion. CapEx can be a good thing because it means you're investing in your business to grow it. As long as your investment in CapEx leads to greater growth in the future, that's a good thing. If your investment in CapEx doesn't lead to greater growth in the future, then you're wasting money. In 2017, they issued nearly $1.9 billion of debt and paid down $700 million, so they added about $1.1 billion of debt that year. Since they had positive free cash flow, it's likely they added all that debt to acquire another business. But the following 3 years, they've been paying down debt. They do pay a small dividend, but another way to reward shareholders is to buy back stock. Only in 2019, they bought back stock of $150 million. Let's look at the capital structure. $10 billion of equity, $5 billion of debt. They're 67% equity, 33% debt. Their net debt is $4.2 billion, and their WACC is 8.1%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $16 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $14 billion. We divide that by 379 million shares. And we get a calculated stock price of $37. They're trading at $31, so they're trading at a 16% discount. It's a buy according to the model. Simply Wall Street values the company at $46, so they're saying it's 33% undervalued. 11 analysts priced this stock in the past 3 months. The average price target was $34. The low was $28, the high was $42. So my valuation is pretty close to the middle of these two numbers. This is the stock price the last 5 years, so you could see it peaked at about $33, $34, but it came way back down, probably due to coronavirus, but the stock has really been driven up. The stock has more than doubled in the past year, sitting at around $31 today. They pay a pretty small dividend, 0.65%. They were paying a much higher dividend back in 2016 of 28 cents. Now they're down to 5 cents. They pay out 11% of their net income and 18% of their free cash flow. The bottom 25% of the market pays a 1.3% dividend. They're below that. And their industry pays a 1.7% dividend. Analysts are forecasting their dividends to grow to 0.8% in the next 3 years. They have a beta of 1.85, so the stock moves almost 2 times the market. It's a bit volatile. The stock has gone up 162% in the past 52 weeks, while the S&P 500 went up 48%. The 52-week low was $10, the high was $35. The stock is trading above its 200-day, but below its 50-day moving average. About 6 million shares are traded each day on this stock. Of the 379 million shares outstanding, 344 million are on float. 78% are held by institutions. 2% of the shares on float are shorted. If you include dividends in the past year, this stock has gone up 168%, while the industry went up 76% and the market 66%. But in the past 3 years and 5 years, this stock has done much worse than their industry and the market. Analysts are forecasting their earnings to grow only 0.6%, while the industry and market grows 19%. The revenue forecast is for this company to grow 5%, the industry 6%, and the market 10%. If you invested $10,000 into this company 10 years ago, you'd be at $4,600 today. The biggest shareholders are Vanguard, Vail, BlackRock, State Street, and FMR. Let's look at their financial ratios. The average PE in the market is 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 17.5, so investors are paying $17.50 for $1 of earnings. Price to sales is stock price over sales per share. They're at 1.3, much better than the median average. Price to book is stock price over book value per share. They're at 1.2. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $9.6 billion of equity, $8.4 billion of tangible equity, since they have $1.2 billion of intangible assets on their balance sheet. Their return on invested capital is only 2.6%, and their WACC is 8.1%. That means they're losing 5.5 cents every dollar they invest. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments almost 2 times. ROE is net income over equity. They're at 7%. Current ratio is current assets over current liabilities. They're at 1.1. And their current assets are $500 million of cash, $1 billion of receivables, and $1.7 billion of inventory. The company does seem to be well capitalized. They had over $400 million of free cash flow, almost $400 million of working capital, and a $76 million dividend payment. So they have over $700 million of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on Nutrien and Scott's, both in the same industry as Mosaic. And if Mosaic has a number in blue, they're better than the average. If they have a number in red, they're worse than the average. So they're better in all the price multiples, which is great. They have a good current ratio, it's above 1. Their ROE is lower than average. They're doing better in debt. And they're the smallest company in this industry, a little smaller than Scott's, a lot smaller than Nutrien. And they pay the lowest dividend. So to summarize, I have them trading at a 16% discount. This company has a really long history, and they produce a ton of product that's used for fertilizer. And fertilizer is always going to be needed. We need crops and farmers to grow vegetables, fruit, and a whole ton of other things fertilizer is used for. I rank their free cash flow 6 out of 10, their revenue 5 out of 10, and their ratio is 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.